Today on Retiring Well with Michael Reese, we'll talk about return sequence risk and why it's so important to be aware of it during your retirement.
Over that period of time, the market's averaged about 6% return. Now, let's imagine that you put $1 million in the market at the beginning of that period of time.
Mike will demonstrate in what scenarios the order of returns does not matter for your bottom line and under which circumstances it will have a huge impact on your retirement savings. You'll be surprised.
It can essentially mean the difference between having a lifetime of financial security and running out of money. And that's something you don't want. You don't want the markets to determine whether or not you're successful in your retirement.
All this and more on Retiring Well with Michael Reese, starting right now.
Retiring Well with Michael Reese, helping you make smart decisions with your money so you can live a better life. Today is the day you can take back control of your money. Retiring Well with Michael Reese, where we believe your best is yet to come.
Welcome to Retiring Well. I'm your host, Michael Reese, and boy, this week we've got a great show lined up for you. We're talking about this thing called return sequence risk. I'm going to say that again because that's a little weird, right? Return sequence risk. What the heck is that? We're going to talk about what it is and why it's so important to you during your retirement. But before we do that, like I do every week, I want to take a moment and share with you why we do this show. You see, I believe your best is yet to come. And I also believe that the second half of your life should be filled with activities where you're able to pursue things that are enjoyable, pursue things that create fulfillment in your life. And the problem is, if you want to spend time chasing fulfillment, doing what's meaningful, you've got to make smart choices about your money. You see, your money supports those other activities. And here's the problem. Most of what you see in the financial media is all about growth and accumulation. It's all about, how do you build a portfolio so that you can retire someday? But what aren't they talking about? They're not talking about, well, once you've got there, how do you successfully get through retirement? How do you protect your principal? How do you take some income? How do you grow your portfolio while you're doing those things? Because let me tell you something, when you're taking money out of a portfolio, it's a whole lot different than when you're putting money in. So that's where we come in. Our job is to share with you smart ways to make sure that you're making those good decisions with your money so that it supports the activities that are important to you during the second half of your life. All right, every week I ask you the same question. Have you called the number on the screen? Have you had your complete retirement review? Well, what am I talking about? We take a look at 4 things when we do a complete retirement review. And by the way, it's absolutely free, so you have no excuse not to do this. First, we help you take a look at your retirement income planning. How are you structuring your income to last for what may very well be 20 to 30 years of retirement? Or put another way, 20 to 30 years of unemployment. What about a risk analysis? How much risk are you really taking with your portfolio? I know everyone that we talk to at first seems to think, oh, we're conservative investors, we're not taking a lot of risk. But then we run an analysis and we learn, oh, wait a minute, what you believe you are is not matching your portfolio. Well, it's better to know that before bad things happen than after. How about costs, fees? What are you paying your money managers? We can tell you that. I think that the financial industry, and this is one of my pet peeves, I think the financial industry is the only industry where they work so hard to hide what you're paying them. Why is that? The skeptic in you should be thinking, well, if they're trying to hide what they're charging me, then they're probably charging me a pretty big number and they don't want me to know it. Well, I would tell you the skeptic unit was probably right. So I believe there should be transparency. We believe in transparency. What are you paying your managers? Are you getting value for what you're paying? And then, of course, fourth, taxes. Okay, taxes, you want to keep your tax liability to a minimum, of course, both today and in the future. And one of the big questions when it comes to taxes I would ask is, what are you doing about that largest taxable asset you have, which is probably your IRA, 401k, 403b? How are you moving money from there into a more tax-favored environment so that those RMDs, required minimum distributions, don't kill you down the road? So just call the number on the screen, get this done. Probably now it's more important that you do this than ever. If you're retired, if you're nearing retirement, then you're at the stage where this complete retirement review would be very valuable for you. It's absolutely free, no obligation. All right, this week we're talking about this thing called return sequence risk. What the heck is this stuff? Well, in order to tell you what return sequence risk is, I'm going to have to go ahead and go over some spreadsheets with you. And I know you may not like spreadsheets, but the good news is I'm going to keep it simple for you. So let's go ahead and get to a couple of these spreadsheets. All right, so this is our first spreadsheet, and it's a real simple spreadsheet. Basically, all we're looking at here is, over here we see it's the S&P 500. This is the stock market right here, the S&P 500, and the returns each year from 2000 to 2014. So the last 15 years in the market, if you will. And you could see we had some negatives. That was the dot-com crash. You might remember that. And then some good years. And then 2008, we all remember that. And some more good years. Over that period of time, the market's averaged about 6% return. Now, let's imagine that you put $1 million in the market at the beginning of that period of time. You didn't add money, you didn't take any money out, you just put it in and let it go. Well, 15 years later, you'd be right here from $1 million up to $1.8 million, 800,000 of growth. Not so bad, right? Not so bad. But what are we talking about? We're talking about return sequence risk, and what that's all about is really, does the order of returns matter? So it doesn't matter if the returns are, that order, or what if they were in a different order? Would that change the outcomes? So I'm going to walk over here and we're going to take a look at that. So our next spreadsheet here is right here. It looks like this. And all we have is this is the exact same thing we started with just a minute ago. Start with $1 million, end at 1.8. So that's the same thing we just looked at. What I did over here is I took this return stream and I just flipped it upside down, right? Just reversed it, that's all, to find out, does it matter? Would we get a different outcome? And look at this, you start with $1 million, same number. So what do we learn? What do we learn here? When you're not taking money out, when you're not adding money, the order of returns, it just doesn't matter. They can come in any order, you get the same outcome. But I don't want you going anywhere, because I said this is vital for your retirement. Because in the next segment, we're going to learn that order of returns can matter a whole lot when you're pulling money out. Don't go away.
Your grandchildren are precious to you. They are your life. This is your time to have that special relationship. Taking care of yourself is taking care of them. Centennial Wealth Advisory is offering a free, no-obligation retirement review to make sure you don't run out of money during your retirement. Centennial Wealth Advisory. Your best is yet to come.
Have you ever heard of the 5% rule? Simple. Consistently earn 5% each year and then take 5% as income. Great, but in this new economy and market volatility, does it work? If I need 5% as income from my savings and the market drops 30% in 1 year, then the 5% I need now turns to 7.1%. Now I have to consistently get 7.1% or more or drop my income accordingly. If interested in a properly structured income plan, then please call the number on the screen.
Essential financial strategies for a comfortable retirement. Join TV host and certified financial planner Michael Reese for an informative and exciting presentation with complimentary gourmet dinner, and learn how to protect your assets from market volatility, how to find growth and security in today's volatile market, how to prevent outliving your money, how decisions in Washington, D.C. are affecting your retirement, how to safeguard your assets from unnecessary taxation, the 4 ways to make sure your advisor is giving you expert advice, and much more. Choose the date that works best for you. November 3rd or November 5th at Texas Land and Cattle in Cedar Park. Presentations start at 6:30 p.m. and are free to attend with a complimentary gourmet dinner to follow. But seating is limited and fills quickly. Call 888-608-5825 or visit send-wealth.com/events to reserve your seats today. There is no cost and no obligation. Don't miss this important presentation, Essential Financial Strategies for a Comfortable Retirement. Call 888-608-5825 today.
Welcome back. This week we're talking about return sequence risk. And basically what that means is, it's a question: does the order in which the returns come make a difference? What we learned is, if you are putting money into an account and you're not putting money in, you're not taking money out, it's just a one-time deposit and you just let it go, it doesn't matter which direction those returns come. They could come in any order we want, we're going to get the same outcome. However, I know what you're thinking. You're sitting there and you're thinking, well, wait a minute, I'm retired. I'm taking money out of my portfolio. Do the order of returns, this return sequence, does that matter now? Or maybe you're thinking, well, that's great, but I don't have 15 years before I retire. I'm going to be retiring in a couple of years, 2, 3, 4 years from now. What about me? Does it matter to me? Well, that's what we're going to look at right now, because here's what we're going to learn. So let me tell you what you're going to see here. When you're pulling money out of a portfolio, the order of returns can make a huge difference. Huge. And it can essentially mean the difference between having a lifetime of financial security and running out of money. And that's something you don't want. You don't want the markets to determine whether or not you're successful in your retirement. So let's take a look at what's going on here. Now over here we have the same exact thing. Here's the stock market again, same thing we've been looking at. Start with $1 million, same thing we've been looking at. But now we're going to change just one thing. We're going to take out $40,000 a year, every year. So let's imagine it's the beginning of the 2000s. You retire with $1 million. And you've heard about this thing called the 4% rule, which says you can pull 4% out of your portfolio. And by the way, remember the market averaged 6, right? For the next 15 years, the markets are going to average 6%. So you're only pulling out 4. You're only pulling out 4%, shouldn't be a problem, right? So here's what happens. The markets, as you remember in the early 2000s, they start off with the dot-com crash. And you may not remember this, but the markets were down, look at this, 1, 2, 3 years in a row, that's 43%. 43% right out of the gate. 43%. You're taking out your 40 grand a year, so not only are you down 43%, you took out 40,000 3 years in a row, that's another 12%. So you're 3 years into retirement, your $1 million is down to, look at that number right there, 525. 525. Now, most people would panic at that point and do something different. We're going to pretend, though, that you are steadfast, you believe in the markets, and you're just going to hang on. So things do get better. They do get better. But at the end of the day, you've pulled out $40,000 a year. You've pulled it out for 15 years. You've pulled out 600 grand. So you start with $1 million. You've withdrawn 600,000. You got about 700 grand left. Right there. See it? 700 grand. And I'm telling you what, that is a scary ride. Look at this. In 08, you're down to 400,000 after 08. I mean, you started at $1 million, you see your portfolio going to 5, it goes down to 4. I promise you, this is not a portfolio that helps you sleep well at night. It doesn't work well. But, what if this return stream happened in reverse? That's right over here. What if it happened in reverse, where the good years were early and the bad years were later on? Well, now look at this. You start with $1 million. You take out your 40,000 every year, just like the other one, 600 grand. But now look at this. You end up with 1.2 million. Start with 1, end with 1.2. Now, let's think about this together for a minute. When it comes to your retirement, what's the goal? The goal for most people is this. They say, protect my principal. Don't you want to protect your principal? Take some income. And if possible, grow it a little bit. Well, in this second example, what happened? You started with $1 million, ended at 1.2. Did you protect your principal? Yes. Did you take income? Yes. Did you grow it a little bit? Yes. That's success. But if it happened in this order, did you protect principal? No.